Today's topic, the theory of financial markets. We're going to try to understand why is Apple trading at $180? Why is Microsoft trading at $360? Why does this stock have a 7% return? Why does this stock have a 3% return? Let's get into it. So last time I talked about the theory of economic equilibrium. And we can use that theory on financial markets, but on financial markets, we can assume one even more basic thing. Think about what we're doing on a financial market. On a financial market, we're trading with money. And money is what we call a homogeneous good. In other words, it does not matter if I own this 2 euros or this 2 euros. They are just the same. Compare that, for instance, with art. With art, it of course matters which painting I own. This painting is different from this painting, right? But with money, it does not matter. And that is what we call a homogeneous good in economics. And because of that property of money, we can use the concept of no arbitrage. And the concept of no arbitrage is one of the most powerful ideas to price financial assets. Let me give you an example. We have two stock exchanges. In other words, two markets where we can trade with stocks. You can think of this as one stock exchange being in Europe and the other one being in America. And on both exchanges, you can buy and sell the stock of Apple. But on exchange 1, the price for Apple is 100 euros. And on exchange 2, it's 105 euros. So what can you do? Well, you can go to exchange 1, buy the Apple stock for $100, and then go to exchange 2 and sell the Apple stock for 105 euros. With this trade, you just made 5 euros. And what you can do is, well, you can do this trade again. You can just go to exchange 1 again, get that Apple stock and sell it for 105 at exchange 2 once again. So you can do this trade over and over and over again, and you'll just be printing money. But of course, the other people in the market realize the same. They understand that buying an Apple stock at exchange 1 is extremely attractive because you can do this trade. So what happens is the demand for the Apple stock at exchange 1 increases. And by the laws of supply and demand, you know from last video that if demand increases, the price increases as well. So this price, the 100 euros, that's not stable. That's going to change. That's going to go up. And think about what happens at exchange 2. Well, at exchange 2, people who want to buy the Apple stock, they will think, well, I can buy this stock here for my 105 euros, or I can also go to exchange 1 and buy the stock for 100 euros. What will I do? Well, no one will buy the stock at exchange 2 anymore, so demand will go down drastically. And once again, laws of supply and demand, the price will fall on exchange 2. So what happens? Well, if the price at exchange 1 will rise and the price at exchange 2 will fall, just to the point where the price is equal at both exchanges. Because if the price is not equal at both exchanges, we will have this dynamic of people buying the stock at one exchange and selling it at the other one, and the price will not be stable. The only way that the price can be stable at both exchanges is if the price is equal at both of them. And that is the law of no arbitrage. Any asset with the same cash flow has to have the same price. And that is honestly an assumption that you can make on modern financial markets. You very seldomly see true arbitrage opportunities. So opportunities where you can make a risk-free profit by just buying and selling a financial asset. But now let me show you how that is used in pricing. Let's say we're Apple and we want to issue a bond. We need money now, and we know that we can repay 210 euros in a year for every bond we issue. And we're not sure what the correct price is for that bond. But we have another bond that we have just issued, and this bond number 2, well, it costs 100 euros today and it pays 105 euros in a year. So what is the price of our new bond that we want to issue? It's kind of obvious, right? It has to be 200. Why? Because this bond, well, it pays exactly double of the other bond. So the price needs to be exactly double. Otherwise, we have an arbitrage opportunity. Otherwise, we have an asset that is our new bond that pays the same as 2 units of our old bond, but has a different price. And that cannot be by the law of no arbitrage. And honestly, this is used in practice a lot. I told you there's an asset class, financial derivatives, which are just very complex cash flows. And there are actually bankers who need to price those very complex cash flows. And what they do is they look at the cash flow and they try to remodel it with other financial assets. It's a bit like Lego building. You have this cash flow, which might look very complex. And then you try to understand, how can I replicate this cash flow? And maybe you find an asset that looks like this, and you find an asset which looks like this. You know that the price of this is 100, that the price of this is 50, so you know that the price of this has to be 150. And one of my old finance professors, he was actually a derivatives trader at Goldman Sachs, and he was in charge of exactly doing that, of pricing derivatives. And he said, it was always weird to me that you don't need to understand anything about finance to get the price for those financial products. You don't need to understand what interest rates are or how the economy is performing. You just need to do your Lego building. You just need to find financial products with the same cash flows to price a different financial product. And that's actually why he quit his job. He said, that always bugged me that I did not have economic knowledge, although I was working in a bank. And that's why I became a professor at university. So no arbitrage takes us quite far. We can use it to price any assets which are just combinations of other assets which are already out in the financial market. But if that's not the case, if we have an asset with an entirely new cash flow, then we need something else. Then we need our theory of economic equilibrium. Just as in every market, the price is determined by supply and demand. And on a financial market, you actually know what drives the demand for assets. I've told you in a previous lesson. It is 3 things. It's the time horizon, it's the return, and it's the risk of an asset, right? Because that's what investors like or dislike. Remember the lesson on the mind of a professional investor. That is how investors think about financial assets. And with this model, we can better understand what happened with the Wirecard stock, which I showed you last time. So in the beginning of 2020, Wirecard meandered around 90 to 100 euros in stock value. But there were already rumors that a lot of the revenues that the company reported were actually made up. And what Wirecard did is they went to an external company, an external auditor, KPMG, which was also my former employer, and said, can you check our revenues and ensure investors that our revenues are actually true and not made up? And in the end of June, KPMG releases the report. And the report says we cannot verify a large fraction of Wirecard's profits. And that is when the stock price falls. Why? Because investors now think that the return on the company will be a lot lower. Before, investors thought that all the revenues of Wirecard were actually true, and Wirecard was making a lot of revenues, which means a lot of dividends for stock owners. But after that report, people were not sure anymore. People thought, well, if a large fraction of the revenues is made up, then our ideas about dividends, well, they have to change drastically. If Wirecard doesn't make any profits, they can't pay out dividends, so our return will be a lot lower. And an asset with a lower return has a lower demand on the market. And by the laws of supply and demand, if demand falls, the price of the stock will fall. So in this graph, in the Wirecard graph, you actually see what our economic equilibrium model predicts. Our economic equilibrium model says if demand goes down, the price has to fall, and you see that in the stock price dynamics of Wirecard. So in this video, we've not made a lot of assumptions. The assumption of no arbitrage, it's a fact about modern financial markets that arbitrage opportunities are 1 in a million thing. And we also talked about economic equilibrium and said the demand is determined by time horizon, return, and risk. But in the next videos, I want to take you a step further and actually give you a formula to calculate the price of an asset. I want to give you the workhouse model of finance, the capital asset pricing model, which allows us to price any financial assets. But in order to get a formula, we need to make a couple more assumptions. So see you in the next video.